Hey everyone, and welcome back to the channel. Today, we're diving into a topic that might sound complicated, but is actually super interesting: the stock market. You've probably heard about it on the news or in movies, but what is it really? And how does it all work? Stick around, because by the end of this video, you'll get it. So let's start with the basics. Imagine a giant marketplace. But instead of selling fruits and vegetables, this market sells tiny pieces of companies. These pieces are called shares or stocks. The stock market is essentially this global marketplace where anyone can buy and sell these shares. It's a place where businesses come to find money to grow and where regular people, called investors, look for opportunities to grow their own money. So, why would a company want to sell pieces of itself? Let's say you have a super successful lemonade stand and you want to open another one in the next town over. You need money for a new cart, more lemons, and a bigger sign. Instead of taking out a loan, you could decide to sell small shares of your lemonade stand business to your friends and family. This process is called an initial public offering, or IPO, when a company does it for the first time on a large scale. When people buy these shares, you get the cash you need to expand. In return, your friends and family now own a small part of your growing lemonade empire. That's exactly what big companies like Apple, Google, or Tesla do. They sell shares to the public to raise capital for new projects, research, and expansion. Now, how is the price of a share decided? It all comes down to a simple, powerful concept: supply and demand. Think of it like a limited edition sneaker release. If everyone suddenly wants those sneakers, high demand, but there are only a few pairs available, low supply, the price skyrockets. The stock market works in a very similar way. If a company announces great news, like a breakthrough product or record profits, more people will want to buy its stock. This increased demand pushes the price up. On the flip side, if the company faces a scandal or reports poor earnings, many investors might rush to sell their shares. This flood of sellers increases the supply of shares on the market and drives the price down. This constant dance of supply and demand is why stock prices are always moving, changing every single second the market is open. So, you've bought a share. How do you actually make money from it? There are two primary ways. The first is through what's called capital appreciation. This sounds fancy, but it just means selling your share for more than you paid for it. If you buy a share for $10 and, over time, its price goes up to $15, you can sell it and make a $5 profit. That's the classic buy low, sell high strategy. The second way is through dividends. Remember our lemonade stand? If your business has a really profitable summer, you might decide to share some of those profits with your shareholders, the friends and family who invested in you. This payment is a dividend. Not all companies pay dividends, as some prefer to reinvest all their profits back into the business to grow even faster. But for companies that do, it's a way to reward investors for their continued ownership, providing them with a steady stream of income. Now, this all sounds great, but it's crucial to talk about the risk. The stock market is not a get-rich-quick scheme. Just as prices can go up, they can also go down, sometimes very quickly. The same forces that can lead to big rewards can also lead to significant losses. If you invest in a company that doesn't perform well, the value of your shares could drop, and you could lose the money you invested. That's why it's incredibly important to do your homework. Before investing a single dollar, research the companies, understand their business, and never invest more money than you are willing to lose. Diversification, which means spreading your investments across many different stocks and industries, is also a key strategy to manage risk. And that's the stock market in a nutshell. It's a dynamic system that connects companies needing capital with investors looking for growth. It's driven by supply and demand, offers rewards through price growth and dividends, but always comes with a level of risk. I hope this video cleared things up for you. If you found this helpful, please give it a thumbs up. And don't forget to subscribe and hit that notification bell so you don't miss our next video. Thanks for watching, and I'll see you in the next one.